How does Apple have superb 772% total return in 10 years? How does Fair Isaac, known for FICO scores, have a mind-blowing 3,179% total return? What about Costco? They are in the ultra-low margin retail business and have an insane total return of 742%. For comparison, Walmart has a paltry 285% total return. Apple has grown its revenue by 7.9% annually over 10 years. FICO, 8.1% annual revenue growth. Costco has revenue growth of 8.5%. These are sub 10% revenue growth rates, very much not considered as growth phase revenue growth, yet they have growth phase annual returns. What do these businesses and a few others like them have that say Dow Jones behemoths Verizon and IBM do not have? The answer is easy to see, yet difficult in the extreme to achieve: an economic moat. Welcome to the Quality Investor. Charlie Munger once said, and I quote, "We've really made the money out of high quality businesses. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. So the trick is getting into better businesses. And that involves all of these advantages of scale that you could consider momentum effects," end quote. The last part of that quote really encapsulates the essence of the infamous economic moat. Advantages of scale that you would consider momentum effects. The United States is a ruthless and cutthroat competitive environment. It is almost a law of nature that something that generates a lot of money, in other words, high profits, then it will attract competition. And in any competitive environment, the initial returns of that first market entrant typically regress to the mean. And if poorly managed, the business could be wiped out forever. In the US, we live and die by capitalism. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Yet, there are a chosen few that seems to beat all the odds. These businesses generate outsized return for many years, despite the presence of competitors that are just as smart and ambitious as they are. What these few truly elite businesses have done is created a durable, competitive advantage, otherwise known as the economic moat. And on today's video, I want to discuss the different types of economic moats. I will cover 5 types to be precise, and not only that, I'll also give primary and secondary examples of businesses that enjoy each type of moat. That is 10 high quality businesses that enjoy massive returns because of the ultra wide moats they have built around their business fortresses. The 5 types of moats are as follows. Number 1, intangible assets. Number 2, switching costs. Number 3, network effect. Number 4, cost advantage. And number 5, efficient scale. These are based on the research from Pat Dorsey. He was instrumental in developing Morningstar's economic moat rating, and he runs Dorsey Asset Management. Sometimes a business can have multiple types of economic moats at once. These are real powerhouses and have made many investors wealthy over the decades. We'll start out with the first one on our list, intangible assets. Intangible assets are effects that are very difficult to quantify, but undoubtedly have enormous economic value to a business. One example of an intangible asset is a patent. It gives the holder exclusive rights to sell a certain product for the life of that patent, usually 20 years. That is 20 years of an effective monopoly on a product. A common form of this is pharmaceutical drugs. You've heard the terms brand name and generic thrown around. Brand name is the original developer of the drug. They enjoyed 20 years of no competition for that drug. Generics are the same formulation rushing to compete in the market once the brand name patent expires. And this is the flaw of patents. They expire. As soon as generics come to the market, the product is now commodified. But there is another form of intangible asset that is far more enduring: the brand. Brands are recognition. Brands are status. Brands shine brightly in a crowded marketplace. They are familiar and easy. And most importantly, they evoke emotion. Emotion is powerful when it comes to selling, and brands can evoke nostalgia, exclusivity, fun, and all sorts of positive emotions humans want to feel. Brand power sells and can lead to high returns for a business. People will generally buy their preferred brand over and over for consumer goods. Some will collect all the products of a single brand. Companies spend massive amounts building brands over time, and some have become iconic. They are instantly recognized the world over and are usually the first choice among consumers, no matter the demographic. This is the pinnacle of brand management, and businesses that achieve this status can enjoy strong pricing power. This gives them greater margins than competitors and ultimately lead to stellar returns for investors. Apple, and in particular the iPhone, really captures the power of brand. The connection consumers have with the iPhone is so strong, Warren Buffett once said, if they had to give up a second car or give up their iPhone, they'd give up their second car. Apple positions the iPhone as a premium product. It's made of high quality materials, has innovative features, and has quite the seamless user experience. It integrates perfectly with the rest of the Apple ecosystem, and that premium positioning allows Apple to sell it at a premium price. This graph here really captures the pricing power Apple has with their iPhone. Since the iPhone's release way back in 2007, the price of the premium phone has just increased over time. iPhones are selling at $1,600, whereas the price of their competition has actually gone down. That's the power of brand. It gives you pricing power in the market. And iPhone consumers are so loyal to the brand, they'll pay any price to get it. On a 10-year basis, Apple has returned 23% per year to investors. And looking at the 1, 3, and 5-year returns, it's a fairly consistent return every single year. And really, that's despite the last few years of relatively flat revenue growth. On a 3-year basis, their revenue growth has only been 2% per year. Earnings per share has also been pretty flat. Despite all that, they have generated massive amounts of free cash flow. In their last fiscal year 24, they had $108 billion of free cash flow. And that free cash flow has really allowed them to execute one of the more impressive share buyback programs in corporate history. While revenues have remained pretty flat over the last years, what has grown is their margins. Gross margins are up, operating margins up, and free cash flow margin is even up. This has increased their ROIC, and that's why you're still seeing incredible returns to investors despite that slowdown in growth. That's brand power. McDonald's is another business with an instantly recognizable brand. And this is a brand known the world over. In fact, nothing encapsulates Americana, in my opinion, more than the McDonald's arches. They serve as a symbol for everything American, and the McDonald's brand has spread worldwide. And despite incredibly flat growth in the revenue over the last 10 years, they've managed to generate returns of nearly 12% per year in that 10-year span. The returns have been down a little bit over the last few years, but their earnings per share has grown a little bit, and it's accelerated that growth in the last couple years as well. Once this free cash flow starts ticking back up, we should see McDonald's returns go along with it. Switching costs creates an economic moat when the cost for a user of the product or service exceeds the cost to remain using the product or service. This creates customer lock-in. Now, combine this lock-in with a subscription revenue model, and you have a powerful model for compounding returns. One is software, which is integrated with vital business processes. Imagine untangling the intricate web of Excel files used for a company's financial modeling. Microsoft Office has very high switching costs. Or imagine a business that uses a certain developer stack. Many developers are trained on certain products or tools, and suddenly switching the tools used in a business will introduce steep learning curves, and that will slow down production. What happens if you operate a high-rise residential building? When you decide on an elevator operator when the building is built, you are now locked in to that elevator operator for maintenance. And that is the real investor value that is created. It is not in the initial sale of a product or service. It is in the ongoing servicing of that product that generates wealth. A customer will sign a maintenance contract with Otis Elevators after one is installed. Software companies have armies of consultants to train users and troubleshoot issues after a software companies have an army of consultants to train users and troubleshoot issues after a software solution is implemented. This generates subscription revenue. Even creative tools have high switching costs. An architect or engineer can spend years mastering Autodesk. It would be a complete waste of time for an engineer to relearn a new tool after mastering Autodesk. They are now locked in. In the world of graphic design, one product suite stands out as the industry leader, and that is Adobe's software. Known especially for Photoshop and Premiere Pro, Adobe's tools are incredibly in-depth and can take years, if not decades, to really master. Once somebody becomes an expert in Adobe's tools, there's going to be very high switching costs to move to other software. This gives Adobe that lock-in I was talking about, and they've also combined that with a subscription service that they implemented right around fiscal year 2013 or 14. And since that time, revenue has reliably and predictably grown every single year. 17% per year revenue growth over the last 10 years, and just last year, 10.24% revenue growth. And right along with it, earnings per share. The free cash flow has been growing steadily as well. There was a one-time blip in this trailing 12 number here, but heading into the fiscal year 2025, we should see that same growth return for free cash flow. And all of that is because of Adobe's products have that high switching cost. It provides them an excellent economic moat. And we can see that as well in the margins. Steady gross margin growth, operating margin growth, and ROIC is also very high, hovering around 76% in the trailing 12 basis, along with a very high return on capital employed, all at over 30%. Amazon is another business that benefits mightily from switching costs, but not in their prime segment. I'm talking specifically about Amazon Web Services, their cloud infrastructure. All of a company's data, things like financial records, customer data, supplier information, all of that used to be stored in on-premises databases. Well, over the last few years, that has slowly migrated to the cloud, and Amazon Web Services is the leader in data cloud storage. So their switching cost is in AWS, and that's because once a company moves all of that data over to a cloud provider, it's going to become incredibly difficult to make another transition to another cloud provider. So Amazon has benefited from that greatly. Amazon's AWS is the clear leader in cloud services at the moment. At its core, Amazon is still a retail business. Retail, though, is infamous for razor-thin margins. If you look at the North America segment, in Q3 2024, net sales of $95.5 billion in the North America segment. This includes some other things besides retail, but look at the operating margin. On a trailing 12 basis, it's at 6%. How does a company have a market cap of over $2 trillion with 6% operating margins in their largest segment? Well, that's because AWS is incredibly profitable and it's growing very fast. Q3 2024, $27.4 billion in sales for AWS segment. That profit margin, way down here at the bottom of the screen, 35.3%. Over 6 times as profitable than the rest of Amazon as a business. Going back to Q2 of 2023, the operating margin was at 24.7%. So not only is AWS the most profitable, it's expanding that margin. And it's growing faster than the rest of Amazon. It has incredibly high switching costs. And that is how we get a business with razor-thin retail margins valued at over $2 trillion in the market. Any goal of a product is to attract as many users or customers as possible. Volume is good, generally speaking, and helps create operating leverage. However, some products or services exist in such a way that their value actually increases the more the user base expands. This is the network effect, and it is a powerful indicator of an economic moat. Social networks are a clear example of the network effect in action. These are direct network effects where the value of a platform directly grows along with the number of users. The internet has catapulted the importance of network effects as the world becomes increasingly digital. An indirect network effect is when the value of something increases through the offering of complementary products or services along with a growing user base. The iPhone is a great product in and of itself, but it becomes even more powerful with the addition of the App Store and other Apple services. Apple app developers benefit from increased iPhone ownership. This creates an economic moat in important ways. A growing network gives more value to users, which drives higher engagement. It's a self-perpetuating system. This can lead to higher revenue growth from increased direct payments and transaction fees. It makes it far harder for competitors to replicate the business model. A startup video sharing service would struggle mightily against YouTube. Aside from hardly any users, the initial users wouldn't be able to monetize their videos because advertisers won't sponsor platforms with almost no traffic. YouTube is in effect a utility in the video sharing marketplace. We really need just one video sharing service. Meta, formerly known as Facebook, is a classic example of a network effect. The original platform, Facebook, becomes more valuable as more users join the platform. And it has a very interconnected ecosystem. Users can connect their Facebook profiles to Instagram and WhatsApp, and that allows for a very seamless experience, but it drives engagement. This also allows content creation to grow exponentially. Again, reinforcing user engagement. And advertisers love this. An engaged user base is like a gold mine for advertisers. Meta's main source of revenue is advertising, and you can see that very healthy growth in revenue over the last 10 years at nearly 33% in the last 10 years annually and just over 15% last year. This has driven earnings growth as well as free cash flow growth. And despite heavy investment in capital expenditures, they're still growing free cash flow at an incredible rate at nearly 23% per year over the last 5 and 3 years. Another huge benefit of this network effect is that once the platform is established, it can add new users at very little marginal cost. This keeps margins quite high, over 80% gross margin and about a 35% operating margin, and it's also increasing returns on invested capital and capital employed over the last 10 years. One more business that benefits very strongly from the network effect is Airbnb. Airbnb is a two-sided marketplace. It connects hosts, which offer supply, to guests, which are the demand, on a single platform. And the more hosts that join, the greater the variety and availability of its listings. This in turn attracts more guests. Having more guests incentivizes more hosts to provide more supply. This is a self-perpetuating ecosystem. And being an Airbnb host has become sort of a cottage niche investment industry within real estate investing. The other valuable part of this network effect is that hosts and guests can review each other. This builds trust and reputation within the Airbnb network. And an indirect network effect of being an Airbnb host is it introduces ancillary revenue streams, such as premium placements, differentiated experiences, extended stays, and so on. In any market, a consumer has choices at various price points. Using retail as an example, there is a whole range of options from discount stores to premium luxury. There are some businesses, however, that have mastered the delicate balancing act between offering high quality but also are cost leaders. These businesses have a cost advantage. Cost advantages can arise from a number of factors. An innovative new manufacturing process that reduces inefficiency, thus reducing overhead cost. Economies of scale that give a business massive negotiating leverage over suppliers or distributors. Walmart can force suppliers to sell them inventory at lower cost because Walmart has a dominant market presence. Vertical integration, where a business controls most or all of the supply chain, can also reduce costs because now the business can cut out the middleman. Tesla controls battery production, software development, vehicle assembly, and uses direct-to-consumer sales. Tesla is also the only profitable electric vehicle manufacturer. Businesses that create a cost advantage then insulate themselves from competition because of high barriers to entry. It can take years to achieve a cost advantage, so competitors are discouraged when realizing only massive capital investment and time are requirements to compete with the cost leader. An economic moat can endure for decades for a cost leader because they can produce at higher margins while remaining affordable, and they operate in an uncrowded market thanks to high barriers to entry. In my view, one business epitomizes a cost advantage more than any other. In fact, it's right there in the name, Costco. Costco has seen massive growth. Its 1-year return alone is at 62.5%. On a 10-year basis, it's returned 21% annually to investors. And this is despite revenue growth being at just under 8.5% per year over the last 10 years. Even Costco's free cash flow growth has slowed down a bit, but that has not stopped investors from piling their money into the stock. Costco, of course, operates in the very low margin business of retail. Yet Costco has an incredibly loyal and membership fee based customer base. This gives Costco enormous purchasing power with its suppliers, so they can negotiate deals that allow Costco to offer such low prices. They also keep costs down by operating no-frill warehouses. They're minimally staffed and they're designed to keep turnover high. High inventory turnover reduces carrying costs. Costco also has a very highly regarded private label called Kirkland Signature. The Kirkland brand itself has power, and this also allows Costco to keep prices down. And because Costco sells a lot of its products at discount prices, it makes them resilient during economic downturns. Costco really is a true cost advantage leader. Netflix is a vertically integrated cost leader. It is a direct-to-consumer platform. So that means it bypasses traditional distributors, which reduce costs but also retain revenue that would otherwise go to intermediaries. It also has a subscription revenue model, creating that recurring, predictable revenue stream. But another part of that vertical integration is that it owns its own content. Netflix has been trending toward owning and producing its own original content, and that reduces dependency on external studios. It also lessens the risk of losing licensed titles, and it gives them control over distribution rights if necessary. This shift has allowed Netflix to reduce its licensing fees while also creating content based on the user data that it collects. Netflix has a very good idea of what will actually be successful, and you can see that shift paying off here in the free cash flow. It costs a lot of money to license content, but Netflix has turned into a free cash flow positive business over the last couple years, and it looks like that free cash flow is going to accelerate. The other benefit of Netflix's vertically integrated system is that it can localize content. Netflix operates in many countries around the globe, and it can create content specific to those various markets and demographics. All of this has turned Netflix into an incredibly profitable business, increasing its margins very reliably over the last few years, and you can see that return on invested capital also steadily increasing, now sitting at just over 21% on a trailing 12 basis. Some businesses can achieve a near monopoly over their market. This is not due to malicious business practices or corruption, but sometimes it is the nature of a market where only a single producer or operator is required to serve a market. This arises when a market is relatively small or heavily specialized. Prior to our new digital age, newspapers operated at efficient scale. Many mid-sized American cities were only able to support one newspaper. There was simply no market for a second competitor. Exceptions existed, of course, for the larger cities like New York, but these are only exceptions. There are quite a few markets just like this. Utility companies tend to operate as monopolies in their geographic area. This is one reason they are highly regulated, which dilutes their profits, making them poor investments. Transportation networks, freight railroads, telecommunications, and specialized manufacturing like aircraft all operate at efficient scale. This type of economic moat is probably the most unstable in that governments realize the potential for a monopoly and thus highly regulate them. But there are some businesses that operate at efficient scale, yet attract big profits. This can be due to the requirement of a standard for others to follow. There are two dominant credit rating agencies, S&P Global and Moody's. Others exist, but once one or two are recognized as the most credible and reliable, it becomes tough for new entrants to compete. These two rate debt for businesses, but what about the creditworthiness for individuals? Banks follow a standard there too. Union Pacific is one of the main operators of the rail networks in the western half of the United States. Along with BNSF, owned by Berkshire, Union operates effectively within a duopoly. Union's rail network covers all the key trade corridors and major ports. That aspect of Union Pacific, as well as the incredibly high barriers to entry due to the significant capital investment required to lay down rail track, Union Pacific operates at an efficient scale. It doesn't make sense to have two competing operators on the same corridor. So because Union Pacific is really the only major operator there, this gives it stable revenue streams, and because rail freight is more fuel efficient and cost effective than trucking, it allows for higher margins. Union Pacific also owns and maintains its rail lines, giving them that infrastructure control. This also helps to reduce costs and increase efficiencies. While I believe Union Pacific is a good example of a business that operates at an efficient scale, like I mentioned earlier with efficient scale, tends to be highly regulated by the government due to its monopolistic tendencies. But one business stands out to me that operates at an efficient scale, but isn't subject to the same regulatory scrutiny as critical infrastructure. And that business is Fair Isaac, known by borrowers everywhere as the FICO score. The FICO score is the de facto standard for credit scoring in the United States. It's become completely entrenched in the financial ecosystem. Not only do you need to understand your FICO score to get good rates up for lending, but even some jobs require you to have a good FICO score to be employed there. So Fair Isaac has risen to the top as the gold standard for rating individuals' credit. So there's already very limited competition within this market, but FICO's reputation has created incredibly high barriers to entry. FICO also has a very stable revenue stream. Many lenders subscribe directly to FICO's software systems, and that provides that recurring revenue. You can see how the revenue has just steadily grown over the last 10 years. 8% on a 10-year basis, 13.5% just last year. The free cash flow has also seen outstanding, predictable growth. 14% free cash flow growth over the last 10 years and 30.7% just last year. And one side benefit of all that data FICO has collected via the credit scoring process, they've accumulated a lot of customer data, which they can license out as well and create more revenue streams. And this entrenched market position has absolutely created wonders for Fair Isaac's margins. We've seen incredible growth in their gross margin, up to 80% in fiscal year 2024, as well as the operating margin up to 42% in fiscal year 2024. And like I always say with margin expansion, it leads to return on invested capital increasing along with it. So this steady revenue growth, margin expansion, and entrenched dominance within the credit market has led to incredible returns for FICO, 41.8% annually on a 10-year basis. And on a 1-year basis, they have a 120.7% return. It is vital to identify the economic moat a business possesses prior to making an investment. For long-term investors, it is what will create those above market returns. I quoted the late, great Charlie Munger at the outset of this video, but there was a part of the quote that I omitted. So let me fill in the rest. Quote, "We've really made the money out of high quality businesses. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years, and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result." So the trick is getting into better businesses. And that involves all of these advantages of scale that you could consider momentum effects. End quote. This single quote has had a profound impact on my own investing journey. It conveys the essence of quality investing so succinctly. So always keep this nugget of wisdom in mind when mining for the next high quality business. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.